Listen, what we just witnessed in the gold market is absolutely unprecedented, and I need to walk you through exactly what happened because this is genuinely historic territory we're talking about here. We're looking at the single largest daily market cap swing in gold's entire history. We're talking $5.5 trillion moving in just one trading session. Let me put that into perspective for you because these numbers are so massive they almost become meaningless unless we really break them down. Between 9:30 in the morning Eastern Time and 10:25, gold absolutely hemorrhaged value. We're talking $3.2 trillion in market cap just evaporating in less than an hour. When you do the math on that, it works out to $58 billion per minute getting wiped out. Every 60 seconds, another $58 billion gone. Then the market completely reversed course. From 10:25 in the morning through the close at 4 p.m., gold added back $2.3 trillion. That recovery phase was moving at $850 billion per hour. Just to give you context, that entire swing represents more than 3 times Bitcoin's total market capitalization moving around in about 6.5 hours. What really concerns me here is that gold's volatility has now exceeded what we saw during the 2008 financial crisis. Think about that for a second. 2008 was Lehman Brothers collapsing, the entire global banking system teetering on the edge of complete implosion, and we just saw volatility in gold that surpasses those crisis levels. That tells us something profound about the stress currently running through the financial system. This isn't normal price discovery we're witnessing. This is forced liquidation followed immediately by panic buying. This is leverage getting absolutely flushed out of the system, and then real money rushing back in to fill the void. Now here's where things get really interesting from an analytical standpoint. The major investment banks are scrambling to revise their gold targets upward, and they can't keep pace with the actual market movements. Just 1 week ago, Goldman Sachs published a gold target of $5,400 per ounce. That target has already been exceeded by reality. Yesterday, Deutsche Bank came out with a $6,000 target, and we're rapidly approaching that level. Then today, JP Morgan published analysis suggesting gold could potentially reach $8,500 per ounce. We're talking about a 52% upside from current levels, according to their projections. The thesis driving these massive target revisions centers on portfolio allocation shifts. Right now, private investors hold approximately 3% of their portfolios in gold. The projection suggests this could increase to 4.6% as households and institutions reallocate capital-seeking safe haven assets. Now, 3% to 4.6% might sound like a modest increase, but when you understand the scale of global investable assets, this becomes absolutely massive. We're looking at roughly $200 trillion in global household investable assets. A 1.6 percentage point shift represents $3.2 trillion of incremental demand flowing into a gold market with a total market cap around $40 trillion. That's enormous marginal demand hitting a market that's already incredibly tight. What's driving this reallocation? Multiple factors are converging simultaneously. Central bank buying has accelerated to levels we haven't seen in decades. China, Russia, India, Turkey, Poland, major central banks around the world are actively accumulating gold reserves. This isn't speculation or rumor, this is verifiable data from official sources. The BRICS nations are actively working to reduce dollar dependence in their reserve structures, which means increasing gold holdings. That's structural demand that isn't going away, regardless of short-term price movements. Safe haven demand is surging across the board. We're seeing geopolitical tensions escalating, concerns about dollar weaponization growing, and a multipolar world order emerging. All of these factors drive capital towards safe haven assets, and gold is reasserting its position as the premier monetary safe haven. But here's what's really crucial. We're also witnessing a fundamental shift away from traditional safe haven assets. For decades, long-duration government bonds were the go-to flight to quality trade. Treasuries were considered the ultimate safe asset. That playbook is breaking down right before our eyes. With government deficits exploding, debt-to-GDP ratios at historic highs, and persistent inflation concerns, investors are questioning the safety of long-duration sovereign debt. Capital that would traditionally flow into bonds during periods of uncertainty is now flowing into gold instead. This represents a massive structural shift in how institutional money and household wealth think about safe haven allocations. And we're still in the early stages of this transition. If household allocation to gold moves from 3% to 4.6%, or potentially even 6%, we're talking about trillions in additional demand. Now, JP Morgan made a critical observation in their analysis that I think deserves special attention. They explicitly noted that gold demonstrates stronger liquidity and breadth compared to silver or Bitcoin. This is enormously significant for understanding capital flows. When you're moving billions or trillions of dollars, you need depth and liquidity in the market. You can't just pile into any asset. You need a market that can actually absorb that kind of size without completely distorting prices. Gold has that depth. Silver's market is substantially smaller and has higher industrial exposure, making it more volatile. Bitcoin has regulatory uncertainty and even greater volatility, making it challenging for large institutional allocations. Gold is winning the institutional allocation war precisely because it offers the combination of safe haven characteristics and sufficient market depth. But let's talk about the very real risks here, because after experiencing a day like we just saw, the dangers are absolutely tangible. $58 billion per minute getting erased means margin calls hit instantaneously. If you're trading gold on leverage, if you're holding futures or options positions, if you have tight stops, this kind of volatility will absolutely destroy you. Your positions get liquidated before you can even process what's happening, let alone react to it. After a move from $3,000 to $5,600 in a relatively compressed time frame, momentum-driven profit-taking becomes highly probable. Pullbacks are normal and healthy in any bull market. We could easily see another $1,000 correction before the next major leg higher materializes. There's another risk scenario we need to consider seriously. If equity markets continue selling off, if we see a genuine risk-off panic where market participants are scrambling for cash and liquidity, gold can actually get dragged down in the initial phase. We saw this exact dynamic play out in 2008 and again in March 2020. Even though gold functions as a safe haven asset, in the very early stages of a liquidity crisis, everything sells off as traders and institutions meet margin calls and raise cash. Then gold rebounds as the safe haven bid returns and central banks flood the system with liquidity. This pattern is well established, but it can be brutal for anyone caught on the wrong side of the initial move. If you're over-leveraged, if you don't have a clear plan for managing volatility, if you're trading based on emotion rather than strategy, this market environment will wreck you. The swings are too violent and the moves are too fast for reactive decision-making. You need appropriate position sizing. You need to understand your actual risk tolerance, not what you think it is, but what it actually is when 58 billion per minute is evaporating. You need cash on the sidelines to capitalize on dips rather than being forced to sell into them at exactly the wrong moment. However, and this is crucial, while the bearish case is very real for traders and short-term positioning, it doesn't fundamentally alter the long-term structural thesis. Every single factor driving gold higher remains in place and is actually accelerating. Central bank buying continues unabated. Safe haven demand is intensifying, not diminishing. The portfolio reallocation dynamic is just beginning, not ending. We're at 3% household allocation moving toward 4.6% or potentially higher. That represents years of sustained demand, not a one-time event. The fact that the market absorbed this morning's crash and completely reversed it within the same trading session tells us something important. That's not characteristic of a broken bull market. That's evidence of underlying demand so robust that even massive forced liquidation events get bought immediately. $850 billion per hour flowing back into gold during the recovery phase demonstrates the strength of that bid. The major banks revising their targets higher in real time and still not keeping pace with actual price movements reveals that they're chasing the market, not leading it. Goldman's $5,400 target from 7 days ago was already exceeded. Deutsche's $6,000 target from yesterday is almost reached. JP Morgan's $8,500 target published today might seem aggressive, but given how quickly previous targets have been surpassed, it's entirely plausible. These aren't fringe analysts or perennial bulls making wild predictions. These are Goldman Sachs, Deutsche Bank, and JP Morgan, three of the largest investment banks on the planet publicly acknowledging that gold could reach $8,000 to $8,500 per ounce. What we're witnessing is a market in transition from one regime to another. The old models for gold pricing are breaking down. The traditional relationships between gold, bonds, and currencies are shifting. New models are still being developed and tested in real time. This creates both enormous opportunity and substantial risk, depending on how you're positioned and how you manage that positioning. The unresolved question is whether the market can handle this level of volatility without experiencing a major liquidation event that temporarily takes prices significantly lower before the next upward move. And if portfolio allocation truly does shift from 3% to 4.6% as projected, how quickly does that capital actually flow into the market? What does price discovery look like in a market that's already demonstrating this level of volatility? We're living through genuinely historic market conditions, the largest daily swing in gold market cap ever recorded, volatility exceeding financial crisis levels, major banks revising price targets by thousands of dollars within days of each other. This is not normal market behavior. This is not stable price action. This is a fundamental regime change occurring right before our eyes, and the old playbooks simply don't apply anymore. For anyone trading on leverage in this environment, you're genuinely playing with fire. The risks are real and the consequences of being wrong are severe. However, if you're accumulating physical metal with a long-term perspective and appropriate position sizing, this volatility might represent exactly the kind of shakeout that occurs before major bull market advances. The fundamentals supporting higher gold prices remain intact and are strengthening. The question is how we get from here to there and how violent that journey becomes. This is Mike with USA Gold Silver Updates, and I'll continue monitoring these developments closely because what happens next could define precious metals markets for years to come.